Nitin Raheja also joining us on the show as Executive Director at Julius Baer. Nitin, afternoon. Thank you so much for your time. Well, start of the new year, FII friends of yours have still not come back to the market and is now giving a sense that will the market oblige with a correction? Everybody is expecting one. What are your thoughts, initial thoughts?
Look, I think it's a correction that we have been long waiting for, and it hasn't happened. I mean, so markets are not normally oblige you when you want to, and will always catch you by surprise. But I think having said that, it clearly, uh, even if there is a correction, I do not think there are going to be any. It's going to be a significant correction, right? You will have what is more of a bull market correction that will take place. I mean, just for example, like today in the morning, if the market was down and then it sort of bounced back. So I think people are waiting for these corrections to buy into them. So I would be so while at the same time when one looks at the fact that we've had two very strong months of market performance, and by that logic, these things never continue, month on month. So you will see a correction. Unfortunately, we don't know when. January has had a track record of starting off strongly and then correcting after some time. But look, the point is that directionally we know that we are in markets which are on an uptrend. We will get these bull market corrections. We can't plan for these bull market corrections. So I think one just needs to sort of remain invested, at least in the near future.
Nitin, where are you looking at this market finding margin of safety? Because yes, you're right, market has given a very big burst of returns in a very short period of time, and still there is a lot of money waiting on the side. So for prudent investors who don't want to chase names which have already done very well and are looking for newer names, margin of safety, where are they likely to spot it?
So look, I don't think just because a particular name has done well, one should not look at those names. I think it has got to do with more with a function of stick to investing in quality businesses, where growth is very is visible, is strong, and also these are companies who have very very strong balance sheets, enables them to invest for the future. So I think keep remaining invested in those. They might sometimes in the market, these companies might take breathers, but they will eventually come back. And also these are the kind of companies, whenever there is a correction, they will fall less and so on and so forth. So I think from a bottom-up perspective, stay focused on high-quality businesses. We have seen a lot of rotation happen. We've seen a lot of expectation built up in sectors that have corrected, hoping that a lot of those sectors, say for example, IT, will come back far faster. According to me, a lot of it is also hope trade that is being played out. So, I mean, and if you ask me a specific sector where I think the valuation, the growth, the pricing looks attractive, clearly it is the financials.
Take a leaf out of that content. And Nitin, I want to discuss about commodity stocks with you. So the PSU commodity stocks in particular, Coal India, Hind Copper, all of them have rallied massively. Coal India, of course, has even raised their production guidance, but we haven't heard anything very clearly from Hindustan Copper for that matter. How have you approached this pocket of commodities, PSUs?
So look, I think what you're seeing, I think there are two factors that are playing out in the market. Because there is a sizable run up in the markets, and rotationally each sector has done well. So you are seeing a sector rotation that is taking place where people are looking for sectors that are relatively cheap, and given where market valuations are, the discount of those sectors has widened, and hence you're seeing this whole rotational trade take place. Last month we saw that happening in utilities, we saw that happening in industrials, and so on and so forth. Now, I think the other element that is playing out, that's how rotationally the liquidity is moving. The other element that is playing out is this whole hope that with the present incumbent government expected to come back, this pace of capex and infrastructure spending is going to continue. And clearly out there, utilities who have traditionally have always been regulated businesses and continue to do so, haven't seen any capex, and hence because of that, there is an expectation of growth falling in place on top of the traditional, utility business that they are in. Uh, Given both of these, commodities are overriding on top of that, especially commodities which are domestically produced and are used domestically. And hence, you have the case of coal companies doing well and so on and so forth. So I think, but we've seen one leg of re-rating that has taken place clearly out there. Um, I don't see these as very high growth businesses. So I would be a little cautious on them, from a future return perspective. It's been a very, very strong year for most of them, but I don't see them really, replicating these returns going ahead.
Names. Nitin, where are you placed on some of these consumer names? HUL, Dabur, Miracles of the world. They have actually underperforming for some time now because of very meek volumes. And the commentary coming from some of the heads of these companies also are not very enthusing a lot of confidence. Would you look at this place or not yet?
Look, when I look at this whole place from a growth value proposition, I mean, clearly they're great businesses, great cash flows, you know, great return numbers, but there is growth which is missing out there. And typically we look at businesses, who are in a high growth mode. We like to invest in businesses where we believe, their earnings can, sort of grow and double at almost 15 to 16% compounded over the next 5 years. We don't find that in some of these businesses. At the same time, the valuations are at very, very premium levels. So it's not a segment that particularly excites us.
Okay, not the most exciting sector, but these which look like that they are in a bit of an overdrive. But what about defense? Because the order books that these companies have got a long gestation period, and they have the visibility of the next 5 to 10 years. And with the kind of relations that we are building up, seems like there's a lot of export opportunity also opening up.
So, I mean, clearly there is a lot of tailwinds given the whole government policy of, indigenizing a lot of the defense components and so on and so forth. So, I mean, so you're seeing a lot of optimism that is flowing through there today, led by government order books and so on and so forth. And that is visible in some of the order books of many companies and so on. But the kind of valuations that we are seeing with a lot of these companies today, believe me, when we will see the actual execution take place over the next few years, it's going to be lumpy. It's a lot like what we saw in the late 2008 in terms of the growth of infrastructure companies and road construction companies, large order books, visibility, but cash flows tend to be very erratic in these businesses. So I don't think the kind of valuations that they trade at sort of warrants the scenario. Clearly, yes, growth is going to happen. Clearly, there is a whole tailwind that is moving behind, but I think a lot of it is actually getting priced into the prices today.
Nitin, since you prefer high growth companies, would you take a look at a Zomato or Delivery for that matter at current levels? They are significantly lower than where they were, and of course, now the management appears sound much more profit conscious.
No, absolutely. I think some of these new age businesses are waking up to the reality of the times, and the reality of the times is that the path to profitability has to be faster, and they don't have access to free cash. When I refer to free cash, I'm talking of access to the VCs and P money the way they had in the past many years, because even today money carries a cost. So and they are also further coming to the public markets, which are absolutely unforgiving in terms of how they value you. So I think a lot of these companies have actually done things, changed their business model and evolved. So the new age businesses, the way we look at it, is are here to stay. The business model is yet evolving, and we are seeing them go on a faster growth to profitability. And surely it's an interesting sector to look at.
Interesting sector to look.
Q3 disbursement updates coming in, 5% growth for this quarter, YOY growth. It will be interesting how the street actually sees that. The stock is off lows though. Nitin, have you looked at some of these NBFCs, which have been growing at a very fast clip, in fact, despite of the bit of a frown from the regulator as well. How are your thoughts on that one? Would you buy into some of these NBFCs?
So I think clearly there is value in a lot of these NBFCs out there, despite the changing regulatory framework that we saw on the part of the RBI and the concerns on personal and unsecured loans, because NBFCs actually play a very important and strategic role in the economy from a growth perspective. But generally speaking, one of the key elements that we look for in an NBFC is the whole underwriting culture and norms, and that according to me is the key distinguishing point, and all the whole re-rating that has happened in the sector in terms of, if you look at the most successful NBFCs, growth being one part, growth runway is very clearly there and defined for most of them. It's the underwriting quality which differentiates what happens to the return on asset or return on equity. And that's where I think the leaders in the pack have actually gone far ahead and trade at a premium. But as a pack, as I said, we are very, very positive on the overall financial pack, and that includes NBFCs.
Continue to stay positive on this pack as a whole, but I think the number that is there from M&M this time seems a bit disappointing, because in the month of November, this number was close to 5,300 odd crores. In October as well, this number was about 5,000 crores. So a bit of a slip coming in the month of December, even if the collection efficiency has been maintained at around 98%. Time now to take the BTSC ideas from our chartist. Naresh, what's the buy today, sell tomorrow idea?
First is a buy on Syngene, which has started showing a recovery, a classical double bottom here, stop loss at 715, target price of 735. Second is a buy on ONGC, testing the previous breakouts of 210, 212. Good risk reward buy here, stop loss at 205, target price of 212.
Point taken. What about you, Kunal? What are the BTSC trades that you're identifying?
So Godrej Properties is something which looks attractive, trading about 2000 levels. So would suggest a buy with a target of 2090, and stop loss could be kept at 1975. And AB Capital apparently has confirmed a very strong breakout for itself. It's coming out after 5 months of steep and sharp correction for itself. So I believe that this could be a very strong turnaround candidate from current levels. 180 is an immediate target, stop loss at 165.
Okay, so maybe after AB Fashions, it's time now for AB Capital to also catch up from the group. That is one of the top bets coming in from Kunal as well. But financials, that's the theme I wanted to discuss further with you, Nitin. I know you spoke about NBFCs, how you like that pack. But within the banking sector as well, the most underperformers have been the top private bank names. The HDFC banks, ICICI Bank, Kotaks of the world. What do you think would be the trigger that will mark the turnaround for these stocks?
I think one of the key triggers is going to be the fact that actually there will be two triggers that will happen. So like I talked to you earlier about how that there is this whole sector rotational going on, where people are looking at which are the next stocks or sectors which are cheaper on a relative basis, and then there's this whole trade that is going on. So this year we had this phenomena where within the financials, the second tier banks actually who had been significantly derated and were trading at sharp discounts actually turned out to be best performers. So whether it was the small finance banks, whether it was a lot of the tier 2 banks, and so on and so forth. So we saw a big rally in this. So the valuation gap between the top banks and the tier 2 banks have now narrowed. So which sort of makes the attractiveness relatively of the larger banks look better. The second element that is going to happen is that we are also seeing a tightening of liquidity, and that's reflected in the fact that we've seen some of the PSU banks actually raise deposit rates. So we're seeing a tightening, and most banks, if you notice the last few quarter numbers, they've been struggling with deposits. So whenever there is a war on deposits, it's the larger banks which stand out well because of their strong liability franchise. So that will work for them. And the third element is that suppose 6 months down the road, or in the second half of this year, you were to see rate cuts actually transpire. At that period of time, some of these larger banks who have superior return on asset and return on equity standing there would actually get re-rated from where they stand today. So I think, it sort of all portends very well for some of the large banks now.
Okay, fair enough. That point is taken as far as the large banking sector.